trade tensions could weigh on domestic demand and thereby also lower inflation. By contrast, a fragmentation of global supply chains could raise inflation by pushing up import prices. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. Looking at the financial and monetary conditions now, risk-free interest rates have declined in response to the escalating trade tensions. Equity prices have fallen amid high volatility and corporate bond spreads have widened around the globe. The euro has strengthened over recent weeks as investor sentiment has proven more resilient towards the euro area than towards other economies. The latest official statistics on corporate borrowing, which predated these market tensions, continued to indicate that our interest rate cuts had made it less expensive for firms to borrow. The average interest rate on new loans to firms declined to 4.1% in February from 4.3% in January. Firms' cost of issuing market-based debt declined to 3.5% in February, but there has been some upward pressure more recently. Moreover, growth in lending to firms picked up again in February to 2.2%, while debt securities issuance by firms grew at an unchanged rate of 3.2%. At the same time, credit standards for business loans tightened slightly again in the first quarter of 2025, as reported in our latest bank lending survey for the euro area. As in the previous quarter, this was mainly because banks are becoming more concerned about the economic risks faced by their customers. Demand for loans to firm decreased slightly in the first quarter after a modest recovery in previous quarters. The average rate on new mortgages at 3.3% in February increased on the back of earlier rises in longer-term market rates. Mortgage lending continued to strengthen in February, albeit at a still subdued annual rate of 1.5%, as banks eased their credit standards and demand for loans to households continued to increase strongly. So, in conclusion, the Governing Council decided today to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you very much.
And today the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you for taking my question. The first one would be on the rate cut. So 25 basis points, has that been backed by everybody, and has there been a discussion about potentially cutting by 50? And then I would like to know your assessment about the re-inflationary or disinflationary effect of tariffs, because there the jury seems to be still out, but you seem to rather err on the side of that it has disinflationary effects, if I'm reading through your statement. Perhaps you could tell me if I'm right. Thanks.
Well, thank you so much for your two questions. I can confirm to you that the decision to cut rates by 25 basis points was a unanimous decision. Options were debated, but there was no one to argue in favor of a 50 basis points cut, for instance. So 25 basis points was definitely the rate cut on which all in the room agreed. Looking at today, and I will happily address the issue of why we actually cut rate, because I think it's a twofold rationale. But looking at today and the tariffs debate that is going on, as well as the tariff impact that is actually happening, we know that it's a negative demand shock. We can anticipate that it will have some impact on growth, but the net impact on inflation will only become clearer over the course of time. And there are diverging views as to the short-term and the longer-term impact of the various, the development of circumstances, because let's be clear, we have a lot of uncertainty still today, and there will be many decisions and many implementation that will take place over the course of the next few weeks and months that will be decisive to err in one direction or the other. But I think the net impact of inflation will become clear over that period. Clearer, I shouldn't say clear, clearer over the course of time. Thank you.
Thank you. And next question goes to Jana Rando of Bloomberg.
Thank you very much. In your policy statement and also in your remarks now, you no longer characterize the policy stance on the restrictive, neutral, accommodative spectrum. And I would be quite interested in why you decided to do that and what kind of conclusions we are to draw from that. And following on, I would like to know whether the direction of travel, as you so often have said, is still clear on policy ahead. And then I want to pick up, so that's kind of a big first one. And I do want to pick up on what you told Annette just now about options were debated. Would you care to elaborate a little bit more on what kind of options were debated? Thank you.
Well, on your first twofold question, right? Shall we call it that way? So, your first question, I think, is very relevant because we did remove from the monetary policy statement a sentence that referred to the restrictiveness and, in particular, as lately qualified the meaningfully restrictiveness or not. And while that assessment of the restrictiveness was meaningful or made sense, to the extent that we were very far away from destination. It is meaningless at this point in time. Meaningless because assessing restrictiveness relies heavily on the comparison between the policy rates and the neutral rate. And I think I had the opportunity in front of this esteemed group to give you my views, and I think the views that are shared by many of us on the Governing Council concerning the neutral rate. Our view, my view certainly, is that the neutral rate, apart from the measurements issues associated with it, is a concept that works for a shock-free world. That's how it is described. And anybody in this room who thinks that we are in a shock-free world, would I suggest maybe raise their hands or have their head examined? Either way. But we are not in a shock-free world, that's for sure. So that assessment of the restrictiveness is not operative anymore. And what we need to do is to determine the appropriate monetary policy stance that will actually take us to our destination. And I will not comment on the direction of travel. I will comment on the destination. That, as you know, is our 2% target in a sustained manner. I think given the cloud of uncertainty that we have, the multiple decisions that are expected, or lack of it, in the next few weeks and months, our stance will have to be determined by two key attributes. And the first one is readiness. We must be attentive to all the developments, and in particular the development of those new shocks, and be able to make the appropriate determination. And that's the first one. The second one is agility. Given the speed at which we see development, the impact they have, the spillovers that we can analyze, it's not going to be a question of rushing to a particular stance, but it will be a question of agility in the face of what we are seeing. And that will require a cohesive approach that will be based more than ever on the analysis of data. So when I have said repeatedly, we need to be data dependent and we need to decide meeting by meetings, and we do not have a predetermined path. I know this has been annoying for some, because there's nothing like having a bit more certainty, anticipating where it's going. More than ever now, we need to be data dependent, and we need to rely on safe, reliable data. We are going to be particularly attentive to all that at the moment. And we will decide meeting by meeting. What is certain is destination. And we're determined to take whatever measures will be appropriate and to use whatever instruments will be appropriate to arrive at that destination. Now, you asked me about the debate. We always debate. And we debate on, all sides of the decision that we ultimately arrive at. And in total candor with you, there were a number of governors who, a few weeks ago, would have argued in favor of a skip. Uncertainty, halo of fog around our navigation, it calls for a skip, and then we will decide when we have more data, the projection exercise that is built with the central bank and the national central banks together. So that was on one side of the debate, if you will. And there were some to say, well, it might warrant a 50, but at the end of the day, this is not what I'm arguing for. So when I say debated, but there was not any single argument in favor of arriving at 50 basis points. So it was a very strong 25 rally of everybody. But we debate, and we, hypothetically try to figure out what it would have been if, or what it would imply if. But I can tell you that it was, I'm sure that you will all do your homework to find out who said what and all the rest of it. But I can assure you that it was unanimous rally about 25 basis points. Thank you.
Thank you. Next question, Balazs Korani of Reuters. Balazs, please.
Good afternoon, President Lagarde. First question is about the outlook. A couple of weeks ago in Parliament, you presented some numbers on the possible impact of a trade war. I wonder if you have an update for us, whether there was such an update made in the Governing Council. Quite a lot has changed. I'm especially interested in what you make of the tariffs and also sharply lower energy prices, significant appreciation of the euro. These all change quite a bit for you. Second question is about your relationship with the Federal Reserve. And I'm asking this because just moments before the decision itself, of course, the US president came out and criticized the Fed, which raises questions about Fed independence and whether the Fed can remain independent. So the question for you is, do you think there is a risk that central banks around the world start to lose independence in this current environment? And also, you have a really important relationship with the Fed, with the swaps. The swaps. Are you confident that the swaps remain in place, they're safe, that you can rely on it? And are you making any sort of contingency plans in case the Fed changes policy on those?
That's a lot of questions, huh? So your first one had to do with whether or not I quantify the current situation relative to previous assessment of the situation. And I will say that I will characterize it as follows. We are in the presence of a negative demand shock, no question about that. But this is not in and of itself, because we can anticipate, and let me be clear on that. When I say we are in the presence of a negative demand shock, some of the tariffs are already in place. And from an approximately 3% average tariff, we are now in the presence of a 13, I'm not giving you the decimal, but roughly it went from 3-ish to 13% in terms of custom duties on average on goods, not goods and services. So that's what we face now. But we also have the prospect of something that could be far more impactful, number one. Number two, there is a series of potential responses on the part of the Commission. We know one or two or three of them, depending on the tactic that is adopted. I think the most obvious one, which has been commented and actually put on the table, is the 0-for-0 tariff offer that has been made. So that's number one. Number two, there will likely be, and that really falls in the category of our risk assessment, there will be some redirection, rerouting of goods that will be supplied by markets that are subject to much higher tariffs, even as we speak now, and possibly other destinations from which those goods could be rerouted to Europe. And third, there are other policies that are also in play and being discussed, including in particular in Germany. So fiscal policies that would see significant investments, significant fiscal impulse that would be given. So you have a combination of either policies, threats of policies of different categories that will obviously have an impact on the situation. Added to which, and you alluded to it, and we actually refer it in the risk statement, there is the appreciation of the euro, which we mentioned specifically in the monetary policy statement, and there has been a significant decline of the price of commodities and particularly price of energy. So you have to combine all that, anticipate that there will be development which will lead me to not actually give you a specific quantification of the impact. Suffice to say that there will be a negative impact on growth, possibly. And as I said, the impact on inflation is, and the net impact on inflation is less than clear at this point in time. So there is so much ongoing that some of which will probably settle a bit by our June meeting. But given that the 90 days will only elapse around the 9th of July and then the 14th of July, Bastille Day, we will know more on that front. And on the fiscal front, clearly the incoming of new governments in various countries, including in Germany, will also take us to a more clarification on exactly where the situation will evolve. But we will, as I said earlier, there is no better time to be data dependent. There's no better time to rely on very strong and solid analysis by all our staff. And I'm glad that June is going to be a combined exercise of the ECB and the national central banks, who will be confronting their respective viewpoint and analysis to arrive at something that will be really consolidated around our three key analytical underpinning, which are inflation outlook, underlying inflation, and transmission. Now, you asked me about the Fed. Let me just say very squarely that I have a lot of respect for my esteemed colleague and friend, Jay Powell. We have a steady, solid relationship amongst central bankers. I think that That relationship is decisive in order to have a solid financial infrastructure on which to make sure that there is financial stability. We have demonstrated in the past that we could actually operate on that basis of consultation and understanding of the financial risk, and we will continue doing so in an undeterred and unchanged manner, I'm sure. Thank you.
The next question goes to Tonia Mastrobuoni of La Repubblica in Italy. Tonia, please.
Thank you very much. Ms. President, do you think that cancelling the tariffs might be enough to restore the trust in the US now? We've seen this mistrust in the dollar, in the treasuries and so on. Or don't you think that the environment is getting worse and this is also destroying the faith in the US? I'm speaking about the attack to the law firms, to judges, to universities. So the certainty of law is vanishing in America. Do you think that this is also impacting on the trust in America? And my second question is, the US administration seems to have also the ambition to push a lot the stable coins. So how dangerous might this be for the euro if we imagine, for example, big companies like Amazon, Facebook, and so on, launching these stable coins, of course, backed by the dollar? Thank you very much.
Thank you so much for your two questions. You know, there is a nice African saying which goes, you never swim twice in the same water. I think for economic players, investors, consumers, employers, employees, all categories, confidence, predictability, and a reasonable level of certainty are important factors for them to make decisions. And I will concentrate on the European Central Bank. In the mandate that we have of procuring and maintaining price stability, we will certainly make sure that we respect those principles. Predictability, confidence, all based on access to the data, the right data, the safe data, and in as much transparency as is possible with all of you. I think this has been recognized by many investors, and this is a clear answer to your question. On the issue of stablecoins, you know that we have regulation in place. It's called MiCAR. It is effective. It's currently under review and consultation for possible improvements. And I'm delighted that this is the case because we are facing a constant evolution of those digital payments, of those cross-border payments, of those stable coins, which I would put in a very separate category from the crypto assets, or however you want to call them. So the stable coins are a different animal. And clearly having a good, solid regulation that constitutes the framework within which they can operate, I think is paramount and has been understood by the European Union, by the Commissions, by various authorities in charge of those matters, and will be reviewed in order to make sure that it procures a safe harbor for those initiatives. But let me take the opportunity of this to acknowledge that for the first time in our monetary policy statement, we refer to the digital euro. And that should be a clear signal that not only do we stand ready and do the hard work that is incumbent upon us, but it also acknowledges the fact that other European authorities are hopefully going to accelerate the pace at which we can deliver. Thank you.
Next question goes to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks for taking my questions. I have one question on the restrictiveness or the kind of lack of description of the restrictiveness in the policy statement. Have you discussed, and maybe can you share your views on, your wider views on this, how much it takes to for the ECB to switch into a stimulative stand over the coming months, given all the headwinds and clouds over growth, and how willing would you be to do so if necessary? And my second question is on financial stability, and in particular your views on the independence of large central banks. How key is it for financial stability that large central banks like the ECB and the Fed are and remain politically independent? Thanks.
Well, thank you for your two questions. We did not the matter of stimulation. We did not discuss the matter of stimulation, and we certainly rallied around the statement that is in the monetary policy overall statement, that we will take the appropriate monetary policy stance and decisions in order to make sure that we deliver on our commitment to reach target 2% medium-term sustainable. So obviously the degree of appropriateness will be measured and exercised through these two principles: readiness, agility in the face of the uncertainty and the multiple decision points that are external factors, and which for some of them constitutes new shocks that are facing the European economy. On your latter point concerning the independence, you know that within the euro area and within Europe, it is particularly important. It's actually one of the criteria that are used in the convergence assessment that applicant new members have to go through. So if a new member who applies to join the euro area does not evidence the independence of central bank, both in its legislative foundation and in its operations, that's an obstacle to joining the euro area. So for us here, independence of central banks is fundamental.
And the next question to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Thank you for Wolfgang. Bonjour, Madame la Présidente.
Bonjour,
I'll switch to English, of course. I just want to recall history on these trade tensions. In 2019, so your predecessor, Mario Draghi, stood here and said there are major downside risks in the face of US-China trade tensions at this time. And in September, ECB responded with a stimulus package. My question is, given the broader conflict that we are facing, is it now just maybe a question of a matter of time before ECB will take further actions in response to these tensions? You told us about readiness and agility, so we are maybe curious.
You doubt it?
And the second, more broadly, questions. Since 2022 in February, the ECB have repeatedly condemned the Russian aggressive and unjustified, quote, unjustified war against Ukraine, and you did it today in your statement. How would you characterize this war? Trade war now that has been launched by Trump against economic partners, because you talk about tensions, but we journalists, we call spade a spade. It's a trade war. So how do you characterize this kind of other war? Thank you.
On your first point, we will determine our monetary policy stance on the basis of what is appropriate in order to reach our target. We will do that demonstrating effectiveness and agility. So analyzing the nature of the shock, the kind of responses that it requires, and doing so in a prompt manner. the downside risk are clearly stated. If you look at the paragraph, now you don't have it because it's not yet on the web page, but I read it for you earlier on. But the downside risks are clearly identified in relation to growth. Will those risks materialize? When do they materialize? Will be a factor of how decisions are made, which decisions are made, what trade measures will be taken, what countermeasures will be adopted, whether there is an escalation as a result. And as I addressed in earlier questions, what kind of rerouting will we be seeing? What measures will be taken to prevent this massive rerouting if necessary? What national and European fiscal decisions will be made over what course, what period of time? You know, when you inject 800 billion in the economy or near 1 trillion euros, it's not a small feast. It's a serious impulse, and it has serious effect, certainly on growth, and to be seen on inflation. But this will be for later and latter analysis when we have more information and more data on these particular matters. You know, I'm not going to characterize what's happening at the moment. I think that the commentators, the top-notch economists who specialize in trade matters all agree that it will have downside consequences. The consequences will differ depending on which part of the world you stand. And that really justifies the fact that monetary policy decisions are not going to be the same the world over. Thank you.
Next question for Stefan Reckius of Handelsblatt. Stefan, please.
Good afternoon, and thank you for the law. Hi. My first question is on uncertainty. You used various degrees of uncertainty in your wording last time and this time as well. Would you say that we are now past peak uncertainty now that tariffs play out in the open, or is it too early to tell? And my second question, if I may, is on the exchange rate, which I'm aware you are usually hesitant to comment on, but still the movements are so big you are even mentioning it repeatedly. So how would you characterize the recent movements in the exchange rate? Do you expect a stronger euro to last, or is it just a temporary episode? Thanks.
Thank you. Thank you for your two questions. I cannot tell you whether we are at peak of uncertainty. I cannot. There is a negotiation which is ongoing. Players around the tables have stated their position. Proposals have been made, at least on one side. But all of that could change. There's a degree of unpredictability which adds to the uncertainty. And you know, if you add to that the incredulity that we've had, certainly in the first phase, where it was difficult to assess and understand, because it was such a break from previous sort of conventional wisdom as to how trade relationships are organized, as was discussed by the WTO yesterday, that I don't know whether we are at peak. What I know for a fact is that the European Central Bank and the Euro system, in our monetary policy decisions, we have to stand ready for the unpredictable, which is why I think it makes a lot of sense to be ready, to be agile, to work on reliable data, and to operate on a meeting-by-meeting basis. We meet about every 6 weeks. Think about the number of changes which have taken place in the last 6 weeks. There could be more changes in the next 6 weeks. But that's in the nature of our job, to stay focused on our mandate, to analyze what is coming at us, and to draw conclusions in order to make the appropriate monetary policy decision that will take us to target. That's what we will do, and we're not going to move away from that. You asked me another question on the exchange rate. Okay, so we are not targeting any particular exchange rate. You know my answer. I've given the same answer 1,000 times here. But we do mention, and we do refer, I think it's in the risk assessment, in the second paragraph, where we say, excuse me, increasing global trade disruptions are adding more uncertainty to the outlook for euro area inflation. Falling global energy prices, that's one, and an appreciation of the euro could put downward pressure on inflation. So we do mention it because of the occurrence, the magnitude, and we try to account for it in the assessment that we make of our monetary policy decision. This is what happens. I think I've answered you 2 questions. Thank you.
Next question goes to Andres Stumpf of Expansión in Spain. Andres, please.
Thank you. 2 questions for me. Does your inflation analysis contemplates Europe retaliating at any point, or you don't speculate about these things? And I mention this because I'm especially worried because digital services could be targeted, and I know you're always very attentive to the service element on inflation. And my second question, it seems the ECB will be diverging again from the Fed. What are the main differences here and there and at both sides of the trade war that could allow you to keep lower interest rates and not Mr. Powell? Thank you.
Well, thank you very much. You know, we have a methodology to take into account developments, and the level of scrutiny is high. Whether it is completely legislated or so certain in its outcome that we can actually take it into our exercise and the analysis that we do. When we are not too sure, we constantly do some scenario analysis to assess and estimate what the impact would be of such or such other decisions. And that exercise will be intense in the next few weeks and will, you know, give rise to some very serious results at our June projection meeting. As I said, thanks to the consolidated exercise between NCBs and ECBs. But currently, if you ask me about the countermeasures, they are not included in the sort of baseline that we have. And obviously, we look at the entire trade balance. We look at goods, we look at services. This is pretty obvious to anyone. We cannot look only at goods or only at services. So I do pay attention to services, but I look at goods as well. The two are intrinsically the outcome of the economy and the trade movements that we have with other parts of the world. So I look at both. You know, I think each central bank in the world does its job in good conscience on the basis of its mandate and on the basis of the currency that it is in charge of and the territory in which it has competence. So that leads us to look at the euro area, not in isolated form, because we are open to the rest of the world and more open than many other economies, including the United States for that matter. But we look at that, we are focused on the euro and we are focused on our price stability mandate. The other central banks in the world have different mandate. They have a dual mandate for some of them, and clearly the macroeconomic situation is different, and they will be on the receiving end of a different nature of shocks from the shocks that we will be receiving. So that leads us necessarily to drawing different conclusions. You know, it is a different situation. Thank you.
That brings us to the end of our press conference today. Thank you very much.
Oh wait, because I wanted to mention something that nobody asked me about, and I want to. Sorry, Wolfgang, but I want to call your attention to one particular segment of our monetary policy statement that you will see, which we have debated and which actually is a clear message from us, central bank, to the other European institutions. And this is the paragraph which sometimes is considered as sort of business as usual, or of course they do refer to this and this and that. This time around, we do specifically mention, with a special timetable associated with it and the swift implementation that we expect, there are 3 categories of structural efforts on the part of Europe. One is the competitiveness compass, which is a derivative of the Draghi report. Number 2 is the investment and saving union, which I've repeatedly called the capital market union. And number 3 is the digital euro. I think we've taken the view that this is a moment for Europe to not only be solid on its monetary policy and not just for us to deliver on price stability, but for the Europeans altogether and the European institutions to actually focus on what opportunities there are, what changes need to take place, and at which accelerated pace this should happen. So that's a strong message from us to colleagues, friends, and other decision makers in Europe. Thank you very much. That's all.
And we see each other again, if you want, on the 5th of June.
Oh, happy Easter to all of you.
Exactly. Thank you. Bye-bye.
That was ECB President Christine Lagarde wishing you a happy Easter. This is Open Interest. I'm Matt Miller alongside Danny Berger. And let's bring in right now Bloomberg's Lizzie Burden. She is live in Frankfurt at the ECB. So aside from a 7th cut since June, what did we learn, Lizzie?
Yeah, the focus more on the words than the action, because the cut was very much priced in today, given Donald Trump's tariffs. Look, we know that now this was a unanimous decision. Even the archhawk Robert Holtzman got on board with this cut. Nobody wanted a 50 basis point cut. That's interesting, even though it was mentioned. They, she says, rallied around the 25 basis point cut. And Christine Lagarde, again, repeated this emphasis on uncertainty, as you would expect. But we really were looking for clarity, Matt. She said that tariffs are a negative demand shock. The downside risks to economic growth have increased, but the net impact on inflation is basically to still be seen. So leaning dovishly, and that's how the markets have read it. You've seen euro-dollar falling, although those bets, that fall paired somewhat while she was talking, but simultaneously traders boosting bets on ECB cuts ahead. So now they're pricing 3, including at that June meeting. But the most interesting thing I have to say today out of all of this was that they dropped the language that policy is restrictive, but they didn't make clear if rates are now neutral. So asked by our reporter, Jana Randau, what we're meant to take from that, she said that neutral as a word is just meaningless at this point because there are so many shocks. So there's no point talking about neutral and restrictiveness given all of this uncertainty. So effectively, they want to keep their options open.
All right, very interesting stuff, Lizzie. Thanks for that roundup. Lizzie Burden reporting live from the ECB in Frankfurt, talking about the now, I guess, uselessness of words like restrictive and neutral. Let's get a quick check on what's going on in the major averages. Here in the U.S., we do see some green on the screen, but not much. The S&P 500 right now up 8 points to 52.84. So after the drop of more than 2% yesterday, we are even further below the 200-day moving average than we were. The NASDAQ up about 0.1%. I wanted to include the Dow Jones Industrial Average here, which we often don't because my co-anchors are so much younger than I am and don't care. But they're out today. So the Dow Jones Industrial Average off more than 500 points. And the reason you see a much bigger drop here than than any drop on the S&P and the NASDAQ is because UnitedHealth is weighted so much more heavily on the DJIA. It's worth almost 8% of the Dow Jones Industrial Average, and it's off almost 20%. So that's why you see that drop. In terms of the other stocks that we're watching, Nvidia, obviously a big heavy mover, and it's down about 1.5% after a huge drop for chip stocks yesterday. This was up a little bit in the pre-market, and as it falls further, you may see the S&P 500 drop as well, because Nvidia is worth, I believe, 6% of the S&P 500 and maybe 9% of the Nasdaq Composite Index. Taiwan Semiconductor gaining 2 1/3% after it maintained a bullish growth outlook and denied a potential tie-up with Intel, and as a result, Intel is down 1.6%. Now I will introduce really my co-anchor filling in for Katie and Sonali. Do you care about the Dow?
I feel like you've kind of implied that I am not youthful because I care about the Dow. So I'm a little bit offended this morning, but that's okay. I do care about the Dow, Matt. And it is because of UnitedHealth this morning. Look how much it is down in this market, down 18%. It's cut its outlook on care costs. Mizuho analysts writing this morning that we might start talking about a management shakeup at that company because they were just so caught off by surprise. On the other side of things, Eli Lilly is posting positive results for its weight loss pill trial. Matt.
I will say that, Katie and Sonali are much more likely to watch the Russell 2000. They care a lot about the small caps, and they're doing better than the S&P.
I could argue that the Russell 2000 doesn't matter anymore anyway. All those companies have been taken private. What's left is not representative of small businesses. So there you go. There's some fodder for you next time, Matt.
All right. We'll continue to have this debate on open interest. Right now, I want to get to, well, it's really been a turbulent week for markets, and especially for Fed Chair Jerome Powell. He faces more pressure to drop interest rates now, but earlier this week, Treasury Secretary Scott Bessent had this to say about the end of Powell's tenure, which, don't forget, is scheduled still for more than a year from now in May of 2026.
Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall.
Yesterday, Powell's comments were part of what tanked the markets, added to Trump's curbs on Nvidia exports, when he had this to say about monetary policy.
For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks.
Now, today, President Trump lashed out at Powell, saying his termination cannot come fast enough. Bloomberg's Tyler Kendall joins us from the White House with the latest on these tensions. And, Tyler, we know that President Trump wants Powell out, but we were calmed, I think, to some extent by Anne-Marie Hordern's interview with Scott Bessent when he said, we're not going to start interviewing candidates until the fall. Is he out sooner?
Yeah, hey, Matt. Well, that's the question here. And of course, there's legal questions. Jerome Powell himself says that he doesn't think that Trump has the legal authority to fire him. And while President Trump has long been critical of Jerome Powell, this would appear to mark an escalation, at least in the rhetoric. Still some big interpretation questions here. Was President Trump pointing to the end of Powell's term as chair in May of 2026, or was he instead calling for the Fed chair to be fired outright just one day after, as you heard, Powell's comments suggesting that the central bank will have less flexibility to cushion the economy amid the tariff fallout? President Trump has often cited that he thinks his tariff policies go hand in hand, he likes to say, with lower interest rates. And we should also note that senior administration officials here at the White House have often downplayed President Trump's criticism of Powell in the past, saying, look, this is his opinion, and that the White House respects the Fed's independence. But we'll have to see if any of them come out with a more stronger stance, perhaps now that the word termination is being thrown about. You mentioned Treasury Secretary Scott Bessent, who told Anne-Marie on Bloomberg Television earlier this week he thinks that monetary policy is a sacred jewel box that needs to be preserved. We should just note, for context, President Trump in the past has indicated that he would let Powell serve out his term, but there are big questions, Matt, about the future of independent regulators here in Washington, particularly after the administration has moved to fire some of them, such as last month 2 FTC commissioners.
All right, Tyler, thanks very much. Tyler Kendall reporting live from the White House. Now let's get back to the markets. Joining us here in studio is BlackRock's global CIO of fundamental equities and portfolio manager of the BlackRock Large Cap Value Active ETF, Tony DeSpirito. Tony, great to have you here. And before we get into, obviously, the large cap value ETF is one that you manage, so you're looking at that universe. But what do you think about this small caps debate? If you had a dashboard with only 3 U.S. equity indexes on it, what would you choose?
So it'd be the S&P 500, Russell Large Cap Value, and Russell Large Cap Growth. And sorry, on the small cap, but if you look at the total market cap of the Russell 2000, it's roughly equal to the largest market cap company in the US. Tells you how it's become less relevant over time.
I think you have a different board now. I think
Yes.
you need to shake things up.
We should pull those up. I'll tell Joe in the control room if you could pull up the Russell large cap value, Russell large cap growth, and the S&P 500. That'll be our dashboard from now on.
Can I ask you how instructive value is at this point? It's typically something that's a little bit more cyclical. You need a growth upswing for it to happen. What is the case for value right now?
So I think that's a misnomer that value has to be cyclical. In fact, I've studied a lot of value cycles over history, value versus growth, and I would say roughly half the cycles value cyclical and half of it time it's not, right? So we all know in the GFC, value did not protect you on the downside, but guess what? In 2022, it did. But when I look at the portfolios I run, I actually run a fairly low beta portfolio in contrast to a lot of value managers. So our portfolio tends to do well and outperform in periods of downturns, and that's because we do have a focus on dividend and, more importantly, dividend growth, and those kinds of stocks prove to be more resilient in tough markets. So I really think it's what is your flavor of value, and that really determines how protective you are on the downside or how cyclically oriented you are.
You actually put, I think, a very interesting fact in your notes, which I wanted to mention. You track value versus growth over the last, I guess, 25 years, right, since the turn of the century. And I think they've changed leadership 28 times in that period. But over the past quarter century, they've performed sort of equally. How do you think that works out? Is it just that they're great diversifiers for each other?
I do think this is a really important point, diversification. Particularly if you look over that 25-year period, in the most recent period, growth has had an incredibly strong run versus value. And what that's meant for investors is that their portfolios are likely out of balance, meaning growth has done really well, better than value, and so their overall growth weighting has probably gone up, not just in their portfolios, but in the indices as well. So we track the S&P 500 over time, and what's the value component versus the growth component? It's way tilted towards growth today. So I think it's really important that investors look at their portfolio, and if they are overweight growth, to get back into balance with value. And those who have done that already have really benefited this year, for example, where value's had a nice comeback so far.
Does that mean if we are near something of the end of the selling that we've seen recently, that what leads us out isn't the playbook that we're used to? It's not going to be tech. It's not going to be those high-flying growth names. That it is going to be value-oriented stocks that leads this next leg higher once we're out of this period, let's call it.
Well, I definitely see the market broadening out for sure, and that's probably good for value. If you look at the earnings growth rate, take of the Mag 7 as a proxy for tech and growth. If you look at 2023, the earnings growth rate of the Mag 7 versus the next 493, the gap in earnings growth rate was 40 percentage points. That's enormous. Throughout 2024, that started to moderate. This year, if you look at estimates, should be high single digits. Next year, even lower. Despite that, despite the converging of the earnings growth rates, the valuation gap is as large as it's ever been.
How do you define value to people that maybe aren't in the market, or even someone like me when I'm asking this question, right? Growth is pretty easy to understand. It's the shooting star on the matrix. But value is much easier to fall into a trap, right? It could be priced for a reason. So what do you look at when you're putting a stock in the BCLV?
Yeah, certainly when you look at the indices, they're just going to look for statistical value, low PE, low price to book. But as you point out, that can be a value trap, right? Just looking for stocks that look cheap. You really need to see stocks that have good earnings opportunities and whose stock prices are low relative to that. That's where the fundamental research comes in. And it's interesting, if you look at, I think that's an advantage of being at a firm like BlackRock is, I sit right next to the growth manager, right? And so I have the growth manager whispering in my ear about companies that are being disrupted. And half the game in value is avoiding that disruption. So I think that's a very important aspect.
Tony, it was so great to talk with you today, and thank you for settling the debate that you should be looking at neither the Dow nor small caps. Both horrible indexes. Thanks so much, Tony. That's, of course, Tony DeSpirito of BlackRock. All right, lots of news in the chip world today. TSMC keeping its bullish outlook for 2025 despite tariff uncertainties. At the same time, Nvidia CEO Jensen Huang is in Beijing today, just about a week after meeting with President Trump and after the U.S. barred sales of Nvidia's H20 chip to China. Bloomberg Technology's Ed Ludlow joins us now. Ed, let's start with Nvidia. What signal should we take from Jensen Huang in Beijing?
Well, let's be completely frank. It's very normal for Jensen Huang to go to Beijing. Nvidia has a sizable footprint in terms of employees in that country. He visits them specifically more than once a year. He's not wearing his leather jacket, according to local media reports. He's in a suit, and the Chinese news agency is reporting that he met with the vice premier. So, you know, it's hard to draw a sort of causal link between the news on the license requirement. That's the basic thing that I want to clarify. The US government is not saying that H20, this chip that Nvidia designed for the Chinese market, is illegal or that it does not conform to the parameters. What the US government said yesterday is that Nvidia needs a license. And what we're inferring is that because they opted to do a $5.5 billion write-down on inventory of H20s, they have not yet applied for or are not going to apply for a license, hence why they had to address on paper the cost of the inventory. So what happens next, who knows? But the timing is timing, Danny.
Ed, can we just talk on air about something you and I were messaging about yesterday, which is that in my mind, it doesn't matter if the U.S. puts H20 export curbs on Nvidia, because the Chinese Communist Party has already advised companies not to buy these chips. And maybe a little bit differently than how things work in the U.S., when the Chinese Communist Party advises you to do something, in China, you do it, or maybe you disappear.
Historically, yes. You're referring to the Chinese National Development and Reform Commission. And the edict or the advisory that they gave to their domestic technology buyers of Nvidia's equipment was, we don't think this conforms to rules that largely stem from energy, raw materials, and supply chain composition requirements. But I think it is an advisory. You know, what we know is that very large Chinese technology companies, Alibaba, Tencent, ByteDance, were the biggest buyers of H20. I think we also know that they had built up inventory of that technology and already had them. So, you know, now the accessibility is not there. But I can't remember if we discussed this on the show yesterday. A side effect of this policy from the United States is if they can't use H20, what are the options for those Chinese tech names? Well, Huawei has a very similar AI accelerator. And so inadvertently, China now has this sort of opportunity to champion its domestic option, which those tech companies may well look at.
Ed, great to get time with you. As always, Bloomberg's Ed Ludlow, a tremendous resource for technology and rocket news, and you can watch him every day at 11 a.m. on Bloomberg Technology. Now let's take a look at what's going on in UnitedHealth. The stock has posted a massive plunge after cutting earnings outlooks for this year. Its earnings outlook for this year, you can see here, off 20% in the cash trade right now. Here with more is Bloomberg's Damian Guard. So, Damian, just tell us what led to this. I mean, they've lost a fifth of their value in today's trade alone.
Yeah, so United missed its quarterly earnings estimates for the first time in more than a decade today, which is staggering in and of itself. But I think what we're seeing in terms of the reaction is largely that this is perceived as an ominous sign for this entire sector, the health insurers and managed care organizations, because United is the largest and most complex and is perceived as kind of a bellwether. And then you have on top of that the growing concern about basically how the government is cracking down on Medicare Advantage plans, which is a huge part of United's business. It's a massive part of basically healthcare in this country. We've seen those things coming into pass over the past year, and then we saw Dr. Oz, who is the incoming head of the government agency that runs Medicare, in his Senate confirmation hearing, taking a really fiery stance on some of the stuff that United really counts on to make its business. So there is just compounding concern about not only this company, but that sector at large.
Jamie, less than a minute here, but Eli Lilly, opposite side of the trade, up more than 16%. What do we know about their weight loss pill?
Yes, so Lilly Lilly had basically picture-perfect clinical data from an in-development pill that would match what we see in injectables like Ozempic, but obviously with a daily oral medicine, which is kind of the holy grail product in this market. Now, these results don't guarantee that Lilly's going to run away with blockbuster success, but this is what investors were looking for from this readout. And so I think we'll just continue to see strength in Eli Lilly in the years to come.
All right, Damien, we're going to continue to obviously have you on because these companies are making big news, and we're talking more and more about pharma as we get into these tariffs. Bloomberg's Damien Gard covers UnitedHealth and the pharma industry for us. Let's take a look at what's going on in markets right now, because very little change on the S&P was what we saw right out of the gate at the open after a 2.25% drop yesterday. But we're starting to see these indexes climb a little bit. The S&P now up 0.5%, the NASDAQ gaining 0.5%, and we've added the small caps back in. I don't know why, because Katie and Sonali aren't back yet.
Justice for small caps.
They're up 0.75%, even though the entire index, as Tony DeSpirito just told us, is worth the same as one stock on the S&P 500 index. This is Open Interest. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are off today.
Coming up, President Trump touts progress on trade talks with Japan and Mexico. Today, he meets with Italy's Giorgia Meloni. Meanwhile, the president piles pressure onto Powell, calling on the Fed to cut rates and saying Powell's termination cannot come fast enough. The Fed chair still has over a year left on his contract. And on the earnings front, Netflix reports today with analysts expecting it to weather the market turmoil better than its rivals. Got a lot of good content lately. Let's get a check right now on the markets and not look at the Russell 2000. Look at there. I put the Dow Jones Industrial Average right up front because Katie and Sonali are off. 39,212. We're off almost 500 points, more than 1%. That is because UnitedHealth weighs so heavily on the index. It's worth more than 7% of the Dow, and it's down 20% today. The S&P 500 gaining 0.4%. We opened little change, so this looks a lot better, although yesterday we were down 2.25% after we heard Jerome Powell say that he really can't cut rates right now due to the uncertainty of tariffs. And the NASDAQ 100 also gaining about 0.4%. We did see Nvidia moving down, and it's tough for the NASDAQ to make gains when Nvidia is a loser. The stock, the big chip maker right now, worth off 1.4%. Now, President Trump is calling a number of trade meetings productive. He took to Truth Social this morning saying he had a very productive call with the president of Mexico yesterday. He says, likewise, I met with the highest level Japanese trade representatives. It was a very productive meeting. Every nation, this is Trump in his tweet or truth, including China, wants to meet. Today, Italy. This follows his talks with Japan yesterday, which he said made big progress. Joining us from the White House is Bloomberg's Tyler Kendall. So obviously, Italy is not nearly as important as Mexico and Canada. But what do we expect from Giorgia Meloni?
Yeah, hey, Matt. Well, today this really is going to be a test on whether or not the Italian prime minister can use her personal affinity with President Trump to try to move forward trade talks when it comes to the European Union. You'll recall Meloni was actually here in Washington back in January for the inauguration, and she's largely considered to have a relatively good relationship with this White House, as President Trump himself says that he will be directly involved in these talks. Now, Bloomberg News reporting earlier this week that the EU trade chief left a meeting in Washington with very little clarity on what this White House needs to get a deal done. And our understanding is Meloni is coordinating very closely with European Union officials to try to see how they could advance talks for the bloc as the whole, considering the tariffs weren't down on country-by-country basis, but instead the entire European Union. Sources familiar do tell Bloomberg that Meloni is expected to float to President Trump, eliminating all tariffs on bilateral trade between the EU and the U.S., essentially creating a free trade zone. Remains to be seen if that's really something that this White House would entertain. But I will say that there is another proposal proposal that we do know of, that potentially there could be an EU-US summit that Maloney is going to float to give member states the ability to talk directly with the administration on issues as trade, but also defense. And I bring that up because, Matt, as you well know, this administration has made a priority to urge these other allies to boost their own defense spending, particularly when it comes to NATO, and that's something that we could see on the table here today.
Absolutely. Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from the White House. Joining us now is Sarah Hunt, Chief Market Strategist at Alpine, Saxon Woods. And, Sarah, thanks so much for coming in.
Good morning.
731 Lex. Let me ask first about the Fed's independence. How important is that to this market? Because when I saw this tweet from President Trump this morning, I was worried that we would see a bigger drop.
I think it is important, and I think, I mean, it's hard to tell how much of this is posturing and how much of this is real. So to the extent that people would worry that there was some change in the Fed because of that, I think that that would not help markets right now, which are not really, you know, they're looking for some sort of stabilization. They're looking for some sort of information on a lot of fronts, including earnings and tariffs. And to add that to the mix, I do not think would be helpful here.
There's also this narrative that's been emerging that the U.S. is becoming more EM-like, especially when you look at last week, where it's volatile stocks, yields up, dollar down. Does this just add to that narrative that we're becoming more like emerging markets and therefore assets might start to trade that way?
Well, I think that the volatility was almost baked in from the beginning of the year, given the fact that we were going to have so many policy changes and that we were coming in with valuations that were very much on the high level. So I don't know about that narrative. And to the extent that there's really nothing as big as the United States, I hear that a lot. And there's a part of me that just says, you know what? I can understand the intellectual argument. From a practical standpoint, though, I don't really think so.
We have seen really 1,000 points lopped off the S&P 500. And I think when people look at their 401ks lately, they're really feeling it. Does that come back? Do we make that back this year as we get more clarity and certainty from this White House? Or do we not get clarity and certainty from this White House?
So I think we're going to just see a lot of volatility. I think right now you've got a lot of questions, right? First of all, earnings expectations for this year are double-digit growth. I think you look at something like UnitedHealth and you think, well, maybe not. So I don't know that we don't see earnings coming down some more. I think that there's going to be an up and down aspect to this market as news ebbs and flows. And to the extent that earnings could be okay for a lot of people, I think that will make a big difference. It's hard to see exactly where this goes. If I knew where it was going, it would be great. But I think that we're just going to have to see. I just expect a lot more up and down and some choppiness this year.
I got to say, even though people are feeling it in their 401k, I mean, we're not technically in a bear market. We're not down 20%. And I told Matt this during one of the breaks. The best headline, I think, today that I saw was from Schwab and their earnings, who said clients are both buying the dip and seeking additional help. So they're buying equities, but they're like, oh, God, please help me. I mean, does the sentiment actually match exactly what we've seen in the market?
Well, and there you have recency bias, right? We just had 2 back-to-back plus 20% years. No one's used to seeing things go down. And so there's a little bit of like, oh, my goodness, it went down. And I think the wealth effect is real. I think people do make decisions based on whether or not they feel extra wealthy or not because of the market. But that's a smaller slice of the pie than the rest of the country. And I think that, you know, it is just unusual after 2022 is the last year where we saw any real negative hit to the stock market. And I think we've got a lot baked into that right now. And you may have to grow into those earnings, which is why I expect more choppiness.
Yeah, I mean, for people like me, I remember 2000, 2001, 2002. That was just a really bad run. I don't think we've ever had 3 years of back-to-back drops like that. But
not in a while.
No, right? I mean,
yeah.
When does the soft data start coming through in the hard data? I mean, when do you start to see problems in the labor market with unemployment rising, real inflation coming back, maybe more than 3%? You know, spending data, obviously, is going to look great right now as we rush out to get stuff before tariffs hit, but after it's going to be tough.
So we were talking about this the other day, and I've been thinking about this a lot because every time you get a change in the timing of those tariffs, you can push out that period of time where people think, oh, I better go do it now. Oh, I better go do it now. And this expectation that it was just March and it hadn't started happening at the end of last year or the beginning of this year makes it hard to think that you could see the hard data keep up longer than people expect it to. And I think that that's part of what we're seeing right now, but it's hard to tell.
So the level of tariffs are one thing, but there does seem to be a change in the contours of the trade tit for tat, where you have Nvidia unallowed or at least needs a license to sell its H20 chips in China. You have China saying airlines stop taking Boeing orders. If more companies specifically are coming under scrutiny, does that change the calculus for investing?
Well, I think this is where the earnings numbers come in, right? Because the growth that's baked into some of the earnings numbers for this year is on the technology side. And if you've got folks saying like AMD or Nvidia, well, that's not going to work so well for me this year, that's going to change your earnings picture. So I think that this is going to keep going until something makes it stop. Right now, we don't have that yet, but I think it definitely is impacting on the earnings picture, and that hurts your multiples and everything else.
Sarah, great having you here. Thanks so much for joining us on Open Interest. Sarah Hunt there of Alpine Saxon Woods. Let's get a look now at the stocks that are moving at this hour. For that, we go to Bloomberg's Bailey Lipschultz, who's still here.
Still here. One more day until I go to Japan. But one of the biggest drivers, guys, to the downside, UnitedHealth, I just want to put a little perspective on this. Right now, it's down 20%. Yes, biggest intraday decline since September 1999, which is massive. Back in 99, the stock was worth $8.5 billion. Today alone, it's lost over $100 billion in market value. This is still one of the largest, though it's not as large as it once was just a few hours ago, one of the largest U.S. healthcare companies. And this is such a big bellwether for the entire industry. So you're chopping expectations, whiffing on earnings for the first time in more than a decade. You're seeing the entire managed care space under pressure because of the uncertainty around Medicare. We are really seeing kind of in real time some of the changes that the administration wants to impact and affect on how health insurance is kind of decided and coverage is doled out, playing out in real time, and that's impacting the bottom line for this company.
Well, if you're a healthcare investor, it's not all woe today. UnitedHealth is down, but Eli Lilly decisively up this morning. Bailey.
It's higher, it's up, it's after, I mean, Matt has tracked the weight loss development drug race like anyone else, right?
I desperately want some Zepbound, but I've been refused twice now.
Well, now maybe you're going to have...
You don't need it. That's crazy.
I do. I'm older, right? I want to avoid a heart attack.
I'll stay out of it.
I want to stave off like Alzheimer's. Yeah. And yeah, I could lose 20 pounds. If I didn't eat a pint of Haagen-Dazs every night, and I can't stop, Danny. I don't have any willpower.
All right, I think part of that is diet, exercise. You know, there are a lot of things that play into overall health. But the stock's up 15%, having its best day since 2023. This coming after a weight loss pill showed that it could rival Ozempic. So you have Ozempic, Zepbound, a number of medications kind of racing for a piece of this ever-growing weight loss pie. And this shows that maybe we'll have a pill which is typically cheaper to manufacture, cheaper to administer, and also has kind of the benefit of maybe you don't have to stab yourself with a needle.
Right. Well, the drug companies are still going to charge us 10 times as much as they charge people who live in every other country in the world. Let's talk about Taiwan Semiconductor because kind of big news for them, but even bigger for Intel, I think.
It's the big thing is that they laid out second quarter guidance that was better than expected. They had pretty solid first quarter net income, maintaining their guidance for the full year. So bucking the trend that we saw ASML laying out yesterday and in kind of a bearish standpoint. But stock's only up 1%, ADRs at least, trading under the ticker TSM. So maybe a bit of relief, but still down about 20% year to date. So this has been one of the many companies under pressure from the AI unwind.
Bailey, thanks so much for joining us. Safe travels. Hope you get one last pint of Haagen-Dazs before you head to Japan.
We should point out that Bailey is on his way to Japan as part of a job exchange program with Bloomberg. So you'll be there for 3 months, and we'll miss you. But maybe we'll see you. Maybe you'll come to us live from Tokyo.
Live from Tokyo.
Nice. There you go. Be very late in Tokyo, but going to hold you to that. Bailey, thanks so much. Bailey Lipschultz there. Okay, coming up, Blackstone beats by a wide margin, but issuing a warning about tariff uncertainty. We're going to dive into the results in today's Wall Street Beat. You're watching Bloomberg Open Interest.
All right, let's get to high interest and look at what's making headlines around the world. The trade war is spilling into ADRs. The chairman of a U.S. Congressional Committee on China is calling on Bank of America and J.P. Morgan to withdraw from working on the Hong Kong share sale of the EV battery maker Contemporary Amperex technology. That's CATL. It's seen as the first step to delisting Chinese stocks in the U.S. Over 200 Chinese companies are listed on U.S. exchanges with a collective market cap of around $1 trillion. By the way, ADR, I think it's American Depositary Receipts. Is that right?
That is right. That's
Thank you very much.
Nailed
Just
it.
so you know. Homebuilder D.R. Horton is cutting its sales outlook thanks to high mortgage rates and growing economic uncertainty for potential buyers. President Trump's tariff war has dragged down consumer sentiment and increased stock market volatility. Tariffs will also squeeze profit margins for builders by driving up prices for construction materials. In similar news, U.S. housing starts fell by the most in a year. Harvard University is pushing back against the government after the president said the school should lose its tax-exempt status, warning that such a move would endanger its ability to carry out its mission and threaten higher education in America. A spokesman for the elite college said there is no legal basis to rescind Harvard's tax-exempt status, and doing so would have grave consequences. But Trump suggested the IRS should tax the university as a political entity. Danny?
All right, Matt, we got some earning news to get through, and it is your Wall Street beat. Blackstone is urging the government to resolve tariff uncertainty as quickly as possible. President John Gray saying a resolution will lead to better outcomes for the real economy and markets. Blackstone's first quarter results showed muted exits for key businesses due to trade tensions. Shares are higher in the pre-market, 1.7%. We are joined now by Bloomberg's chief Wall Street correspondent, Sri Natarajan. Sri, what were your takeaways from their earnings?
Look, the first most important thing as to why we care about Blackstone is it is the largest alternatives firm. It is the largest commercial property owner, and depending on what criteria you use, also the largest non-bank lender. So if you take all of that into account, what Blackstone has to report in its earnings has a broader read-through across the broader U.S. economy, perhaps even the global economy. The results themselves are a smidge better than what analysts were expecting, and that's why you see the stock up a little bit today, up 1.7%. But the bigger picture remains that since the election, since the post-election high, since the post-election jubilation in the stock markets, Blackstone's off roughly 25% this year, even higher if you go back to late November. And the issues there are clearly pretty much on the horizon. When you rely on the movement in the asset market, on deal making, and realizations in real estate are lower, realizations in private equity are lower, it does present a bit of an uncertain future ahead.
When do we start seeing these private equity companies saying, they have real problems with their portfolio companies, or that they need to restructure debt?
So two sides of the equation in terms of the private equity. From a deal making perspective, if you're out there looking to find good targets, this is a good time, right? Prices are lower. In fact, John Gray did talk about the idea with how much prices have fallen. There is an opportunity to jump in. Blackstone is looking for attractive deal opportunities, perhaps not so much in the physical goods space, but it wants to be active. It has about 177 billion in dry powder, most of that in private equity and real estate. But the flip side of the equation is it also makes it a harder environment for exits. And that's important for private equity. That's been a challenge over the last couple of years. They were really hoping that the post-Trump election, the post-Trump mania in markets would carry through much of this year. That hasn't really happened yet, and with all the tariff chaos, may not happen for a little while longer.
Well, John Gray was also continuing this trend that we heard from the banking executives, and that was to comment on trade, maybe not talk about Trump specifically. But do these executives, John Gray saying that we need a faster resolution, is this an audience of one that they're speaking to during these earnings?
Audience of one with a lot of respect directed towards that audience, right? The language has certainly been more muted, very neutral. He even talks about the need for governments to move quickly on tariff resolution. Yes, you can call on various governments to take that action, but really this was set off by one man, and they're really trying to tell him this is not good for business, and they would really like this resolved as soon as possible.
Do you hear more and more of the donor class making these arguments? Because I guess that's the most effective way to deliver President Trump a message that, they're going to cut off the funding for the Republican Party.
So yes to the first part. I'm not so sure if that's necessarily the most effective part. Yes to the first part because, yes, the donor class is affected by what's happening in markets. When asset prices go down, they all start to worry. You saw some of the change in language for someone like Bill Ackman when the initial week of post-Liberation Day tariff announcements, right? And you've seen some other prominent players in markets talk about the risks there, and they are typically your GOP mega donors. But is it necessarily the most effective way to get through to Trump? I'm not so sure. He is a billionaire president. He's been talking about doing whatever he's been doing in this first 2 months in office is something he's been talking about in his last 2 years on the campaign trail and pretty much for the last 20, 30 years of his business life. So is it necessarily the most effective way to get him off the ledge, get him not to talk about that and not to focus on that, I don't know. I think he will pay attention to the markets, and the markets continue to go in this sort of tailspin mode. That will get the president's attention more so, much more so than a Ken Griffin or a Bill Ackman.
All right, Sri, thanks so much for joining us. Sri Natarajan runs our finance coverage out of New York. Let's get a check on the markets here. We have been seeing bigger gains on the S&P 500, and they've now turned around. As you can see, we're closer to unchanged there. The NASDAQ is also unchanged, but with a red arrow. The Dow Jones Industrial Average continues to underperform the other major indexes because UnitedHealth is such a huge holding, more than 7% of the weighting, and it's down 20% today. This is Open Interest.
Let's look at what's moving the S&P 500 with the MOV function on your Bloomberg terminal. We're at the lows for the session, but it is two opposite stories when it comes to healthcare. On one side of the ledger, you got Eli Lilly, the best performer, with some positive results from their drug pill. Let's go over to the other side, though, because a loser is also in healthcare. UnitedHealthcare down a whopping 20%, dragging the index down 13 points. The second worst performer, Nvidia, that continuous chip story being negative. I want to show you what the sectors are doing because it won't surprise you, given what I just pointed out. You have most of the sectors in the green this morning. By the way, I should have shown you on the other screen. Breadth is pretty good, despite the fact we're basically unchanged on the index. So you got energy outperforming, oil is up, and then you got the safety kind of indexes. You got utilities, retail, consumer staples, but check out what's on the bottom here. The two things I just mentioned. It is healthcare, the worst performing sector this morning because of UnitedHealth, followed by info tech. And Matt, I know this is something you always look at. Nvidia is such a huge weighting in this index. The fact it is down again, even though Jensen Huang is in Beijing trying to appeal to China, saying you're still a very important market, there's a lot of negativity around chips, a lot around Nvidia. So that index, Matt, down 0.5%.
Yeah, absolutely. And by the way, even though healthcare is down, you see the other defensive industry groups gaining today. So energy, utilities, consumer staples. And I think that when they're in leadership, that's a really bad sign for the market overall.
It is a bad sign. And again, that just goes to emphasize how poorly UnitedHealth is doing today. You showed it's dragging down the overall Dow index, but you have everything that safety stocks doing well except healthcare. Mizuho analysts writing that the news was so shocking at UnitedHealth that it was such a miss on their costs that soon, Matt, we might be talking about a change of leadership over at that company.
All right, Danny Berger, thanks very much for that. Now, we've been kind of making fun of the small cap index, but small businesses are extremely important to the U.S. economy, and small business owners are lobbying for tariff exemptions. Among them, Allison Luvera, Juliet CEO and co-founder. She joins us next. This is Open Interest on Bloomberg. Welcome back to Bloomberg Open Interest. We are looking at now all three major indexes falling, with the Dow Jones off more than 600 points. The S&P 500 only down 0.1%, but it was down 2.25% yesterday, and the NASDAQ down 1/3%. I'm just waiting 7 more seconds until I can break the news that we have on embargo, and now we're exactly at 10:30 even. The Fed in Philadelphia is naming Anna Paulson as its next president and CEO. Let's get to Bloomberg's Mike McKee with the breaking news.
Well, Matt, she is the current director of research at the Chicago Fed, a job she took on in 2019. And so she's a Fed veteran, came to the Chicago Fed in 2001, expertise in financial markets and in particularly in insurance, and then how institutions affect people's views of their finances. She's, as I said, been at the Fed since 2001. At 60 years old, she can serve 10 years at maximum. She replaces Patrick Harker, who is retiring because he's hit the Fed's retirement age. She'll take over on July 1st and then become an immediate member of the Open Market Committee, but start voting in 2026. So a change at the Philadelphia Fed, Patrick Harker retiring, Anna Paulson, the director of research at the Chicago Fed, taking over July 1st for Harker.
Is there any work from her, anything we can point to as to where she kind of falls on the dovish
hawk spectrum
kind of spectrum, how she feels about this current environment? Is there anything like that out there?
Not in her basic research that we've seen, because she works in a support capacity to the Chicago Fed president, currently Austin Goolsbee, and of course he's been quite dovish recently, so perhaps she's supported that, but her writings have basically been on macro and microeconomic issues, as I said, the insurance industry in particular.
Isn't there a function on the Bloomberg where you can sort of chart where people fall in terms of dovishness and hawkishness?
The Bloomberg economics people do something like that, but they don't go down as far as research directors.
I see. Okay. I want to ask quickly just about the data, because the data, the hard data that we've been getting in doesn't look bad in terms of consumer spending, in terms of inflation, in terms of the labor market. And we just got initial jobless claims in today that are actually better than expected at 215,000. What are economists saying about when the soft data that looks so bad, like consumer confidence, is going to come through into the hard data, if at all?
Well, it should be within the next month or so. The Philadelphia Fed showed a real collapse in their index this month in terms of both headline and new orders. But inflation expectations went up in that. So kind of puts the two mandates of the Fed at tension, as Jay Powell said yesterday. Does that translate immediately? It's hard to know, although we have seen a decline in, you look at the Philly Fed's new orders index. If that continues and then people start to pull back because they're worried about tariffs, then we should see it maybe by May. April's kind of hard with retail sales because we've got a late Easter this year. So we'll see it soon enough.
Mike, thank you so much for the breaking news on personnel changes. I think this market hopes that that is the only personnel change that is to come for the Fed. Bloomberg's Michael McKee, thank you so much. Now, a group of small business owners are urging for exemptions from Trump tariffs. 40 women founders and CEO joined forces to pen this letter, saying the taxes pose a threat to the vitality of their business. The movement was led by the co-founder of Juliet Wine. Allison Luvera is with us now. She is, of course, the co-founder and CEO of the boxed wine maker. Allison, thank you so much for joining us this morning.
Thanks for having me.
So in speaking to your peers and even within your company, how much has sentiment and concern soured in this current moment we're in?
So I think that, small businesses, which are vital to our economy, are feeling as though disproportionate harm will be caused to companies like ours because of not only the current and proposed tariffs, but because of the general uncertainty around them. And so there is a lot of frustration and there is a lot of concern around different ways that we can, move forward as sustainable businesses.
I know that female founders get a really small percentage, for example, of venture capital. Only like 2% of venture capital funds go to female-founded businesses. But in the larger picture of small businesses, why are you looking for this exemption only for female founders?
So to be clear, we are a group of female founders, but we are advocating for the wider business community. So we're not asking for exemptions or any sort of support just for women. And in fact, one of the interesting things we've seen since we issued the letter last week is that there's been an outpouring of support from businesses from diverse backgrounds, diverse industries. And so in order to broaden the reach, we've actually launched a change.org petition just last night in order to, bring more people into the fold and allow more business owners to voice their support for what we're trying to achieve.
Including men.
Including men.
So you've heard from more businesses, thank God. You've heard from more businesses. Mm-hmm. Have you heard from anyone from the administration since you've sent out this letter?
Yes, so we've been conducting outreach. We've had a handful of really promising conversations. Can't share with whom yet, but I think it's safe to say that you will see us in Washington soon.
I wonder about the effects that tariffs have on you, because as I understand it, you grow your grapes, make your wine here in the U.S., right? So
exactly.
You're not facing tariffs from things you import, right? Unless you import like cardboard boxes, for example. Are you worried about tariffs on things you export?
No, and I'm glad you asked that because I think it illustrates a really important point that even businesses like ours who, we source the majority of our product here in the U.S., most importantly our wine, which is from California, we do source different packaging components from overseas, from a few different countries. And so even organizations like ours that are primarily U.S. made are seeing moderate negative impacts from this.
What about second-order effects of souring consumer sentiment? Have you seen any change in behaviors of people's willingness to spend and buy?
So we've seen a lift in sales short term. It's hard to say if that's from, consumers maybe stocking up ahead of tariffs and potential price rises. From the perspective of my company, Juliet Wine, we will, in the short term, try to not raise prices. We offer a great value for money. It's something that we're really proud of as a business. And so even a 10%, 20% increase in prices feels very much at odds with our brand promise.
I would also imagine that you may feel positive effects at Juliet, right? Because if I can no longer afford to buy a bottle of Gruner Veltliner or some wine that comes from Europe because of tariffs, I might make a choice to buy a California wine at a lower price.
It's a great point, and it is a possibility that domestic wine brands will see some sort of short-term lift in sales. I think the wider point, though, is that the industry as a whole will be really negatively impacted, our distributor partners, our retail partners, and so if they're hurting, we're going to hurt. For the industry as a whole, I think it'll be negative.
Well, one of the conversations we've been having at Bloomberg is this idea, and Matt's been really fantastic on this all day. The soft data, the surveys are really bad, but looking at just data itself in terms of the labor market, it's really good. And I wonder when you're talking with your peers who are clearly concerned, are they starting to have the conversation of, do we need to do layoffs? Do we need to rethink about things like pay as well?
Definitely. It's a conversation that a lot of my peers are having. I think many companies are starting to think about how they can streamline operations in order to make up for these increased costs that they did not foresee coming. And, reduced labor forces is definitely one of the factors that people are thinking about.
I have one more quick question, and I'm not sure how directly you work with the vintner. What's the American word for that?
Winemaker.
The winemaker, exactly. So because of the, mass deportations and the closure of the border, I imagine that labor is much more expensive for people in California trying to pick grapes.
So it's definitely not an area of the value chain that I'm personally very involved in. I have heard conversations and some chatter about that, about sort of the evolving workforce and labor force in, the vineyards in California and in agriculture in California in general. So I think it is top of mind for wineries and winemakers.
Allison, this was so fascinating. Thank you so much for joining us. That is Allison Luvera of Juliet Wine. By the way, pretty cool flex to be like, I forgot the English word.
So
for this
I haven't, since I moved back to the U.S., I've stopped drinking.
Yeah, okay, that's understandable.
But until 2022, I was living in Germany, and I was drinking as much as I possibly could. Mostly of Gruner Veltliner, which is why I bring that up.
Well, we'll have to see when Juliet comes out with their alcohol-free wine.
Yes, absolutely. Let's take a look at some of the stocks moving at this hour. Charles Schwab, first of all, interesting trade there after daily average trades exceeded expectations. And as Danny was talking about earlier, the company says retail investors have been rushing to respond to market volatility, although they're asking for help, which is, to me, there's a question mark here. Like, are Charles Schwab's customers asking for more margin? Are they asking for advisory help? Are they just saying, like, in general, help? Like, I don't understand what customers at Charles Schwab are asking for help with.
Just that imagery was fantastic. But I think it seemed to me to be the advisory help. I wasn't 100% clear on this, but it just showed this like reflexive need to buy the dip, even if you're freaking out at the same time.
Yeah, well, retail definitely looks like it's been doing that. Amex maintaining its full-year outlook, saying its wealthier clientele continue to spend in spite of tariff-induced volatility and uncertainty. And then we've been talking about TSMC, Taiwan Semiconductor Manufacturing Company. It is continuing to keep a bullish outlook for 2025, but also, I think, interesting. By the way, It was up like almost 2% earlier and only up 0.2 now. But also saying that it's not interested in buying Intel, which I guess was a relief to some TSMC shareholders, but not for Intel. Those shares are down. Coming up, Netflix reports later today. Robert Fishman of Moffettnathanson takes us through what to expect from, I would say, the dominant streamer. This is Bloomberg Open Interest.
Some breaking news in this hour. Google shares have now erased any gains that they've had, down 2%. Google has partially lost its U.S. advertising tech antitrust case. It means that a judge in Virginia has ruled that they illegally monopolized some ad tech markets. As a result of this, it is possible that Google will have to dismantle some of its ad tech business. Again, the advertising market's so big for Google. Again, Google partially losing a U.S. advertising tech antitrust trial. Matt.
All right, that is some fascinating stuff. And Google has definitely suffered. If you look at the year-to-date chart of the shares, they're off about 20%. Let's get to Netflix right now because it reports results after the bell. And earlier this week, the Wall Street Journal reported that the streaming giant is aiming to join the $1 trillion club. I'm sure they wouldn't mind that because right now they're valued at about 414 billion. So they'd have to more than double their market cap. Joining us to tell us if it's possible is Moffettnathanson senior research analyst Robert Fishman. Robert, it seems like a heavy lift to get there. Can they, you think, more than double their shares in the near-term future?
Well, that journal article was really fascinating because what it actually did is reinforce a lot of the reasons why we upgraded Netflix a few weeks ago now. And a couple of the key data points in there was roughly a doubling of the revenue and a tripling of the operating income. And that is led by advertising, and the expected growth that they have is to exceed $9 billion by 2030. So all of these very significant growth data points were largely consistent with our increased confidence that we have in the business model and how the strong revenue growth is really going to flow down into profits and drive really high returns on invested capital here.
It underscores a really confident Netflix. And Robert, last time we had any sort of an economic downturn, it was COVID. And of course, Netflix did well because we were all at home and literally the only thing we could do is sit at home and watch TV. If you do get more weakness in the American economy, what happens to Netflix this time around?
It's a really great question. I'm sure it's going to be asked, 10 different ways tonight after the company reports. But the best answer I can give you today is because of this advertising tier, what they really did was a significant price cut, if you want to view it that way. So their upper premium prices of $18, $19, even $25 a month now after the recent raised prices. But then now they have this ad tier, which is essentially a really big unlock of a whole different subscriber universe that they can speak to now at $8 a month. And so they now have an option over the past couple of years, and a part of, or a large driver of their subscriber growth has been these cheaper tiers and allowing customers that can't afford the more expensive tiers to come in at a much cheaper price, even relative to a lot of the other streaming companies' ad tier options. And another reason why we got so much more confident in this story was when we looked at the engagement that happens versus the monetization that happens at that engagement levels. Netflix is really under-monetized, and that was like a really big awakening moment for us to understand what the upside potential is as they lean into this advertising.
Why does Netflix continue to be, Robert, so dominant in streaming, as we've seen such a huge amount of competition come into the market? Is it first mover advantage? Do they spend more to produce content? What is it that keeps them at the top?
Yeah, I mean, you kind of hit on two of the big ones. Clearly, being a first mover has given them a lot of advantages. I think it's fair to say that most people, even back to the prior question, if they're starting to consider areas to save in their wallet, Netflix is likely to be last on that list in terms of what they're looking to potentially cut. So I think being first and being cemented as the streaming dominant player in the US and around the world, importantly too, has given them significant advantages. And the fact that they've grown their content budget as high as it is, call it roughly $18 billion on content, we actually think that they're going to lean in more to that advantage over the next few years and become even bigger in sports and become even bigger on original content, because that's just allowing them to further disrupt and lean into their own advantages.
Well, hopefully we'll get that color in about 5 hours' time when Netflix reports after the bell. Robert, thank you so much for your time this morning. Robert Fishman of Moffettnathanson. Coming up on the show, Harvey Schwartz warns investors stay buckled up for more volatility ahead. We'll have part of Sonali Basak's interview with the Carlyle CEO next. This is Bloomberg Open Interest. Carlyle Group CEO Harvey Schwartz says that investors should continue to brace for more market volatility. He sat down with Bloomberg Sonali Basak in Morristown, New Jersey, for an episode of the upcoming series Bullish for Bloomberg Originals.
I think they should still stay buckled. It's just a question of whether or not the airbags come out now. But I think that, I think this is an environment where if you have a lot of tolerance for volatility, then you can lean in. I think if your tolerance for volatility is low, then you should be protecting capital.
So Fed Chair Powell has said that he is concerned about the prospect of persistent inflation. Now, because of that, you have a market that is increasingly concerned about stagflation. Is that a scenario you're concerned about?
I don't think there's a scenario I'm concerned about. I think the Fed chair has done an amazing job in his role, whether it was navigating the pandemic, navigating the spike in inflation. I think we see the stickiness of inflation in our portfolio companies, as we talked about earlier around the KPIs. We can see the fact that there's not marginal demand destruction, which actually would drive prices lower. So inflation does feel sticky, but inflation being sticky in and of itself is not a bad factor. That's actually a reflection of a strong economy, low unemployment. I think the concern people have now is that business activity slows, but because of the policy decisions, this is a period where prices are elevated, and you end up in that part of the Venn diagram for a period of time where you do have elevated prices and a slowing economy. And I think, but sticky inflation at the rates we're at now, I don't actually think in and of itself independently is a concern. It's a question of whether or not we do get a slowdown in business activity and inflation remains sticky, and then, that is a concern.
So when is it that you think the Fed can start cutting rates again?
Well, that's a decision the Fed will make, but I think what the Fed has shown us is in periods of uncertainty, and this is a period of uncertainty because we're in a new policy regime geopolitically, is that in uncertainty, I think they do the right thing. They track the data. And so the good news is they have a lot of financial flexibility here at this level. So they can easily cut rates. What they don't want to do is cut rates unnecessarily and then be behind the curve and have to come back up. And so I think what they've communicated to the marketplace is we're going to watch the data very, very carefully. If the data indicates to us that unemployment is rising or inflation gives us a little more slack, then they're going to cut rates. But I think they're doing a wise thing right now because uncertainty is high and this is a new regime. And so I think, again, I'm super complimentary of their actions.
What is it, if anything, that keeps you up at night right now?
I wouldn't say it keeps me up at night, but I think if you think about the information we're all seeing in the marketplace, it's really critical for the global economy and for trade that we and China find a place of cooperation at an equilibrium. And I think the faster that can happen, the better it is for all business activity globally, especially in the United States.
That was our very own Sonali Basak talking with Carlyle CEO Harvey Schwartz. You can check out, by the way, that full interview on Sonali's upcoming Bloomberg Original series. It's called Bullish, and I guarantee it's going to be a massive hit.
I don't know how bullish people are, though. I feel like in this environment, everyone she's talking to is a little bit like, I don't know.
I still, especially at these price levels, as we've come down so significantly. I mean, on stocks, I think there are a lot of people who are bullish. Tony DeSpirito at the top of the show seemed like he saw a lot of opportunity in this market.
Yeah, fair enough, especially in value stocks, which have been so underloved. The last time that they did well was in 2022. So if not now, then when?
All right, let's get a quick check on markets as we head to break. We are looking at losses across the board. So I guess today's the day. Enjoy your holiday weekend. Coming up on Monday, we have Amy Wu Silverman, the CEO as well of General Catalyst. This is Bloomberg.